Introduction. In this module, we focus on how the choice between cash and accrual accounting affects the day-to-day operations of a business, financial reporting, tax obligations, and long-term strategic decision-making. Understanding these impacts is essential for business owners, accountants, and financial managers to ensure accurate financial statements, regulatory compliance, and effective financial planning.
Business suitability, when to use cash or accrual accounting. Cash accounting suitability. Typically used by small businesses, sole proprietors, or businesses with simple transactions and minimal inventory. Advantages due to its simplicity and direct focus on actual cash inflows and outflows. Cash accounting offers straightforward tax reporting and ease of understanding. Accrual accounting suitability, preferred or required for larger businesses, businesses carrying inventory, or those needing detailed financial tracking. Required generally accepted accounting principles, GAAP, and many tax authorities for certain businesses. Provides a more accurate reflection of financial position matching revenues to expenses when they are incurred, not just when cash changes hands. Effects on financial statements and business insights. Revenue and expense recognition. Cash accounting recognizes revenues and expenses only when cash is received or paid. Accrual accounting recognizes revenues when earned and expenses when incurred, irrespective of cash movement. Impact on profitability reports. Cash accounting may show fluctuating profits if cash flows vary significantly. Accrual accounting smooths income and expense recognition, offering better insight into ongoing profitability. Balance sheet differences. Accrual accounting records assets such as accounts receivable and liabilities such as accounts payable, which do not appear in cash accounting. Impact on cash flow management. Cash flow challenges. Under accrual accounting, profits may appear positive even when cash is low, risking liquidity issues. Cash accounting directly aligns with cash flow but may obscure future receivables and payables. Importance of cash flow forecasting. Regardless of method, businesses must forecast cash to avoid insolvency. Accrual accounting requires careful management of working capital to ensure operational funds. Tax reporting and regulatory considerations. Area and tax rules. Certain small businesses qualify to use cash accounting for tax purposes, but inventory rules and revenue thresholds may require accrual accounting. Switching accounting methods requires approval and adjustments. GAAP and IRS compliance. Public companies and entities reporting under GAAP or VERTA must use accrual accounting to ensure comparability and transparency. Changing accounting methods. Process of transition. Businesses wishing to change from cash to accrual, or vice versa, must submit a formal request, IRA Form 3115 in the LUA. Adjust prior financial statements to reflect the change accurately. Implications. Potential tax adjustments or liabilities may arise during the transition. Professional accounting advice is strongly recommended. Practical examples and decision-making scenarios. Example is a small consulting firm uses cash accounting because it receives payment immediately and has minimal inventory or credit transactions. Example 2. Retail business uses accrual accounting to track inventory costs, accounts receivable, and payables for accurate profit reporting and tax compliance. Example 3. Growing business considering expansion evaluates switching from cash to accrual accounting to obtain financing, attract investors, and comply with accounting standards. Summary. Selecting between cash and accrual accounting has significant effects on financial reporting, tax obligations, cash management, and business decision-making. Small businesses may opt for cash accounting for its simplicity, while larger or inventory-heavy businesses are typically required to use accrual accounting. Businesses must carefully consider regulatory requirements and operational realities before choosing or changing their accounting method.